Hi everyone, good afternoon. Thank you so much for joining. So welcome to today's webinar. So today we're talking about financial advisors and we'll be aiming to answer the questions, are they worth it and do you need one? So just to briefly introduce myself before we get started, I'm Amy Staines and I'm the Senior Financial Education Manager at Better with Money. And Better with Money provides unbiased financial education to help people really understand their finances and hopefully help to build some financial resilience too. Now, just a couple of notes before we start. Please feel free, as Fiona has already said, to ask questions as we go through and we'll pick these up at the end. And whilst we're talking about financial advisors today, I won't be providing any financial advice myself, but rather this webinar is providing information only. And my aim today is to give you the tools and knowledge to help you make good decisions when it comes to your finances and choosing financial advisors. And importantly, I also want to highlight that Better with Money is completely independent. So if I mention organisations and websites today, it's because we genuinely believe they offer valuable services that you can take advantage of, and not because we receive any sort of financial incentive to do so. So the world of money and personal finance can sometimes feel really overwhelming. And whilst doing your own research is a really good start, it can sometimes be a good idea to talk to an expert when you're making those important financial decisions. So over the next half an hour, we're going to be looking at various areas relating to financial advisors. So we'll start by setting the scene and talking a little about the regulatory landscape. We'll then explore the different types of financial advisor out there. We'll look at the reasons why you might use a financial advisor, looking at what they can help with and also what they can't help with. And we'll then look at how to find a financial advisor and things to consider when choosing one. And we'll wrap up by looking at how to prepare for your first meetings before going to that Q&A. So let's first set the scene then by quickly looking at the regulatory backdrop when it comes to financial advice. So back in 2012, the then Financial Services Authority, which is now the Financial Conduct Authority, created and introduced the Retail Distribution Review. And you may hear this referred to as the RDR. Now, this set of rules and regulations was designed to fundamentally change the way in which financial advice operated in the UK, and it came into force on the 31st of December 2012. And this was really in response to concerns that customers were receiving inappropriate advice, which was leading them to buying products that didn't meet their needs. And the regulator also had concerns about fees and commissions and whether these were actually having a negative impact on customer outcomes. So the goal of these new rules was to really improve transparency in the industry, shed light on the true costs associated with advice, also demand higher qualification standards for advisors, and also ensure advice was unbiased and truly suitable for the individual. And it was hoped that this would also lead to greater confidence and trust in the financial services industry more general, more trust in the financial advice that retail customers were receiving, and generally improve the overall quality of service across the industry as well. And I will refer back to the RDR as we go through the slides, because it has resulted in a few important changes to financial advice that still remain in place today. And one of these key changes under the RDR was making sure that retail customers knew exactly which type of advisor they were working with. And that brings us really nicely onto the next slide. So the first point I want to make here is that there are different types of advisor out there who provide advice on different things. And it's for that reason that you might not always hear a financial advisor referred to as such, but rather they might actually be named by their specialism. So for example, mortgage advisor, pension advisor, investment advisor, they might even be a financial planner or a wealth manager. And you might also hear them referred to as brokers in some cases, particularly those dealing with things like mortgages and insurance. So if they're suitably qualified, whereas other advisors may only look at mortgages and insurance. But in general, regardless of specialism, all financial advisors must make it very clear what their remit is. And this means defining themselves and their advice as either independent or restricted. And it's really important to know the difference between the two. So The first one, independent. So independent financial advisors consider all types of products from all firms, and they do that when coming up with a solution for their clients. So these financial advisors will consider many different products, funds, ETFs, investment trusts, pensions, annuities. They will have a much broader remit and require knowledge about all products and all providers in the market. That doesn't mean they have to recommend all of those. It just means they have to consider them when making their recommendation. Now, on the other hand, there are restricted financial advisors, and these focus on a particular market or particular products from different providers, which means they are more specific provider, but they don't have the same ability to provide advice across the whole of the market. Now, it is worth me highlighting that mortgage advisors wouldn't fall under the remit of the RDR in the same way. But still, in the same way as with investment and pension advisors, independent mortgage advisors can offer a broader range of options from across the whole of the market, whereas restricted advisors in the mortgage industry might be tied to just one lender, for example. So that independent versus important for mortgage advisors, even if they don't fall under that RDR remit. So now we know about the different types of advisor, it's time to look at why you'd use one. And in general, whether you need financial advice or not will depend on your personal financial circumstances, your short, your medium, your long-term goals, your own personal financial understanding and experience, and also the complexity of your needs and the financial product you're talking about. So let's go through some of the reasons why you might want to work with a financial advisor, and we'll then consider why you might not. And these aren't exhaustive lists, but hopefully give you some ideas and things to think about. So if we start with why you might use one then. So the first reason is if your financial situation is particularly complex or stressful. And taking professional advice in this case can help you both practically and emotionally. So from a practical perspective, an advisor will be able to recommend a financial product that meets your needs. They will help you put in place a financial plan for the future, and they can help you make difficult financial decisions as well. And if we look at that from an emotional perspective, you'll probably feel more supported and confident knowing that any decisions you make are not rash, they're not emotional decisions, but they were actually really carefully considered with that professional oversight. And this is particularly true when thinking about situations like divorce, perhaps moving home, estate planning, retirement planning, or considering what to do with inheritance, for example, because all of these things can be quite emotionally overwhelming. Now, the second point is that to purchase some products or to make some financial decisions, you're actually required to take advice. And this is really so you understand the implications of what you're doing. So, for example, you wouldn't be able to transfer a defined benefit, final salary pension, into a defined contribution pension without taking formal financial advice. But even in situations where taking financial advice isn't compulsory, it might still be advisable. So, for example, if you don't fully understand how a particular product works, or if you are finding it difficult to decide between different options, for example, that might be a reason why you'd seek support. Now, moving on to the third point. So, depending on the type of advisor you use, you might also have access to a wider range of choices than you'd realistically be able to uncover by yourself. And this might actually mean, therefore, you're able to settle on a more suitable solution for your circumstances. And it's really important to kind of think about if you didn't get advice, because in this case, you might risk not considering all of the options available to you, or you might buy a product that isn't suitable. So moving on to point 4, then that's all around tax efficiency. And this can be a really, really complex area. And advisors can, in this case, provide expert guidance in areas that you might not even have thought about. And this actually can save you a lot of money in the long run. But if you do know and you do know the areas to think about, then using a financial advisor can also provide reassurance that you're doing things properly. Obviously, areas like tax are really complex and there can be penalties if you get it wrong. So using an advisor can make sure you're being tax efficient, but still complying with all the rules and regulations that you need to be mindful of. Now, the next point is about the ongoing support that financial advisors can provide. Because in some cases, your financial advisor really does become someone who you can bounce ideas off and they become a real partner to your overall financial strategy. And this ongoing support can really help keep you on track as well, because the advisor can keep an eye on things on your behalf to make sure your money's doing what it's supposed to. And then finally, when you get regulated advice, the financial advisor is providing a personal recommendation based on your circumstances. And if you did end up with an unsuitable product after taking advice, then you may have more rights to complain or claim compensation. So that's the additional protection that actually using a financial advisor can provide. But it is worth remembering with this point that you still wouldn't get protection if your investment were to lose money if markets went down. So it's an important distinction there. But there's some of the reasons why you might use a financial advisor. So let's consider why you might not. So the first point here, you might decide against seeking financial advice if you've already got a good level of financial knowledge about a specific product. So for example, cash savings accounts or cash ISAs can be relatively easy to understand. There's loads of information out there to help you. And you can look at different options via comparison sites online, for example. And in this case, you might feel confident making your own decisions. And cash products are also often quite easy to buy direct from providers as well. So you might just make the decision that actually, with particular products or situations, you might not feel the need to take advice. Now, the second point is around situations where you may actually get a better deal by going to the provider directly. So, for example, if you're looking for a mortgage and you approach your existing lender, for example, that might actually get you a better deal than going through a mortgage broker, for example. And this brings us on to talking about fees, because financial advice doesn't usually come for free. And we will talk more about the different types of fees you might come across in a few slides' time. But fees should factor into your thinking. So again, if we think about a mortgage advisor, they might charge an advice fee when you could actually get that same mortgage by going direct through your lender, which is usually free. But it is important to remember with fees, there may be still other fees involved. So with investments, for example, you may have to pay platform fees or management fees, and that's the case whether you take advice or not. And you should also consider the cost of fees against the financial and emotional costs of making a poor financial decision if you didn't take advice. So sometimes it might be worthwhile paying a fee if you're going to receive some really, really sound, useful financial advice. Now, the next point is that some advisors may have minimum wealth thresholds. So, for example, your pension pot might have to be a certain size, or you might need a certain amount in cash before talking about investing. I would contrast this though by saying, while some advisors may require you to meet certain wealth thresholds, you will more than likely be able to find someone who you can talk to, because just as many don't have those minimum criteria. So please don't let a minimum wealth threshold put you off seeking advice if you feel that you need it, because there will be someone out there that can help you. And the final point here, you may be unsure whether the advisor's interests are aligned with yours. And it is a really fair concern to have. Again, though, I would counter this by saying that the regulatory backdrop is really strict, and this is there to protect you as the consumer against unsuitable advice. But if you're still not sure, based on all of this, all of these points, whether or not you need advice, there may be opportunities to have a free consultation with a financial advisor. And this is something many do offer. So you could always meet with one, use this as an opportunity to find out more about what they could do for you. And then you can make that decision as to whether you want to use one and commit to the process or not. But hopefully that slide has provided a few things to consider. So once you know whether financial advice is for you and you have an idea of the type of advisor you need, the next question is, how do you go about finding one? So we'll just go through some of these points now. So the first way is through personal recommendations from friends, family, colleagues. Often if people have had a really good experience with with a financial advisor, then that can be a good first step to finding one. But if you don't know anyone who has used a financial advisor recently, then the next place to look is actually at work. So, for example, some employers might partner with financial advice firms and they might offer a discounted fee as an employee benefit, for example. Or perhaps your employer simply has a list of firms that they recommend. And that might be the case for your pension scheme as well, because these often have a list of selected advisors that they recommend to their members. And similarly, some unions and affinity groups might have similar lists or panels that you can take a look at as well. Now, the next point, if you are happy taking restricted advice, so that's where it's not independent, it's not whole of market, but it's more limited, then you may want to approach your bank or building society, but you should remember that they will probably only be able to advise on their own products, as I say, not the whole market. So with this approach, you should remember that other companies may offer other cheaper or more suitable products for your needs, but they might be worth having a chat with. And outside of these, there are other organisations as well that can put you in touch with qualified advisors in your area. So these are Unbiased, Vouched For, and the Personal Finance Society. And you can find on those three both independent and restricted advisors. And there are a couple of others as well. So there's also the Money Helper Retirement Advisor Directory, and you can go here to find an advisor who can help you make decisions about your retirement. And there's also the Society of Later Life Advisors as well. And this is a not-for-profit society, and they can help you find advisors with the Later Life Advisor accreditation. And as I say, you will get these slides in the recording with all of these links, so you will be able to follow up. So once you've found your financial advisor and you've contacted them, as I say, most will offer a free initial meeting. And this is a really, really good opportunity for you to get a sense of whether you'd be happy working with that person. So let's go through some of the key things to think about when choosing a financial advisor. So no matter what type of financial advisor you use, they must be regulated by the Financial Conduct Authority, sometimes referred to as the FCA. And they need to be regulated to be able to provide financial advice legally. And being regulated means there are certain rules they must follow and standards they must meet. And you as a consumer will have greater protections as a result. So always consider whether an advisor is properly regulated. And you can check this by visiting the Financial Services Register or contacting the FCA directly. And if an advisor isn't registered with the FCA, this is a big red flag. And you can make a complaint to the FCA if that's the case. And part of being regulated does require advisors to have appropriate qualifications, and there are minimum professional standards of qualifications that all advisors must meet. So, for example, for advisors captured under that RDR that we've spoken about, there's a requirement to hold a minimum of a level 4 qualification. In reality, many advisors will have achieved qualifications above those minimums, so the Chartered Financial Planner, for example, and some may also have specific qualifications covering their specialist areas, so equity release or pension transfers, for example. And if an advisor is on the Financial Services Register, you can be fairly confident that they are suitably qualified for the job. But in any case, please don't be afraid to ask an advisor about their qualifications. Ask to see a statement of professional standing, because any suitably qualified advisor would be more than happy to talk about this and show you their certificates. So something to be mindful of, and definitely ask the question. Before we move on to the next point, though, I do just want to make a point that you should be really wary of taking financial advice from just anyone. So that includes family, friends, colleagues, internet sites, bloggers, people you see on social media. Lots of people might think they know lots of things about money, but if you act on any sort of advice from individuals who aren't legally regulated and qualified to do so, then you don't have those protections if that advice ends up being unsuitable. So do be really careful on those first 2 points around regulation and being suitably qualified. But moving on to the third point, we've already heard that financial advisors can be independent or restricted, and it is important that you understand the scope of the advice you can expect. So you should know whether they provide whole of market advice, whether their advice is restricted. If you need someone to advise on a specific area like retirement, then consider finding a restricted advisor in retirement. That might be appropriate in that case. But if you do want someone who's able to look across the whole market and across all products, then independence will be key. And on a similar note, understand whether they do have any particular specialism that you'd be looking for. Now, the next point is around fees. We've touched upon these briefly, but we know financial advice will most likely come at a cost. So you do need to consider how this works and ultimately whether it's worth it for you. So any advisor must clearly explain how much their advice will cost. It could be a set fee. You might agree that your advisor can take a fee from the sum you're investing, for example, but be clear on whether fees are one-off or whether they're charged periodically. And actually, independent financial advisors do typically have an upfront fee, but also ongoing commission built in. Some might offer that ongoing advice where they charge an annual fee, and for that they will continue monitoring your financial situation. They'll offer an annual review every year. Other advice will be one-off for a single standalone fee. And it's also worth noting that other types of advisor, so particularly mortgage and insurance brokers, they might get paid commission on any product they sell. So you should be very clear on any fees involved and feel confident that any fees that are being charged are in line with the regulatory guidelines for the type of advice you're receiving. Now, just to go through the next points then, the next one is about years of experience. Now, this doesn't necessarily mean the advice will be any better, but you may feel more confident working with an advisor who's lots of experience of your situation. You could also ask them to share examples or case studies of work they've done in the past. Knowing the advisor has a sound reputation within the industry and amongst other clients can also be a really big green flag. So perhaps read reviews. You can find these on the Vouched For website. And the next point is a really practical one, but it's all about how you will work with and interact with your advisor. So would you prefer to meet in an office? Would you prefer them to visit you at home? Would you need any flexibility to meet in the evenings or at weekends? Because if these points don't align, then actually working through the advice process could become quite difficult. And ultimately, it all comes down to whether you feel like you can work with this person. So think about how you feel around them. Have they built a good rapport? Can you see yourself having really open and honest conversations with this person about your financial situation? And do they seem genuinely interested in you and your financial goals? And ultimately, if you choose the right person to work with, then the whole financial advice process can be really quite enjoyable. So on this slide, I've just pulled together a list of questions that you might want to work through in your initial introductory meeting. And as we've already said, you'll get a copy of the slide so you can print this list off. But once you've had that introductory meeting and decided you want to go ahead and work with that advisor, they will schedule what we call a fact find meeting. So this is where the advisor will ask questions to learn more about you, your circumstances, your goals, priorities, your appetite for risk, amongst other areas as well. So this is to provide them basically with the information they need to go away and come up with your personalised plan where they will recommend those financial products. So few points just to make the most of that meeting. What can you do to prepare? So consider completing a budget planner to give you an idea of your monthly income and expenditure. And it also informs you what you need on a monthly basis, which is particularly useful if you're talking about the income you might need in retirement, for example. It's worth gathering workplace and private pension statements, and also consider checking your state pension forecast as well by accessing the gov.uk link on the slide. Gather any other paperwork, existing investments, savings, and this also goes for your partner as well, particularly if you're taking advice jointly. And another point is think about your goals, your financial goals over the short term, the medium term, and the longer term. And this includes thinking about any purchases or projects on the horizon as well. So particularly those that are going to have an impact on your cash flow. And finally, be prepared to answer questions honestly, because financial advisors will need to get a really good, honest understanding of you. So this does require you to be really open and kind of ready to share lots of information. So just to finish off then, I've put on this slide some really great websites where you can go to read more. And as always, when we finish these sessions, I just want to reiterate that you have access to lots of support through the ICE Benevolent Fund and the support network. So you've got a 24-hour support line if you're part of the ICE. If you or a member of your family wants to talk, they will give you free practical tailor-made advice on how to manage your debt. And the support network similarly works closely with PayPlan, who offer you and your family confidential debt and budgeting advice as well. So worth knowing that they exist. Now I can see loads of questions have come through. So Fiona,
They have
hand back over
indeed.
to you.
Thank you. I've made a note of all the questions. So if we can't get, I don't think we're going to get chance, unfortunately, to answer them all. But when Sarah sends out the recording of today's webinar, we will send out a Q&A document, which will have the questions and answers that you've all raised for today. So just a couple of them. The first one we had was, is it usual to ask more than one financial advisor for advice and a fee? And how much information can I expect to receive before agreeing to a quotation for a financial advisor service?
Yeah, so the first point then, there is absolutely no problem having multiple financial advisors. There's nothing stopping you from doing that. And some people do. They might want to access different types of advice. They might want a second opinion. They might want to kind of generally diversify their relationships with advisors, or use separate advisors for kind of different goals or different assets, for example. So there are kind of advantages in that you can get a second opinion, you might be able to access lower costs, you might be able to get a slightly different view on things, but you should just consider the kind of flip side of that and any disadvantages. So obviously, the more advisors you work with, the more time that's going to take up, because you'll have to have various meetings. It might be that you're paying multiple advice fees, so you should consider whether the cost is worth it. And in some cases, the advice might overlap or conflict in some way, which can actually add confusion when you're looking at planning. So as I say, no reason why you couldn't use multiple advisors. And if you feel like the benefits, are sufficient to justify perhaps paying multiple fees, then, that's a decision that absolutely you can make. But do consider why you're using multiple advisors, and actually could this create additional challenges if you're duplicating effort, or if you're kind of receiving conflicting information from those. So that was the first part. Fiona, can you, sorry, just remind me of the second part?
Yeah, absolutely. How much information can I expect to receive from them before agreeing to the quotation?
Yeah, so realistically, this will probably depend on the advisor you're using and the firm they belong to, because different firms will probably have slightly different processes in terms of kind of the information you receive ahead of agreeing to that quotation. So it's worth asking that question. I'd say, what can I expect from you? And that's, to be honest, a really important part of speaking to them in that initial meeting. What can I expect? When can I expect to receive this information? And at what point will the fee become payable? Because it might be that actually the fee only becomes payable at later down the line, when you've already kind of received some benefit and some value from that advisor. So will vary between the advisors, and worth asking that question directly.